Hey there. Thanks for tuning in to another RTD News Update. Today I have a variety of articles, all pretty much dealing with currency and what's happening in surrounding currencies globally. So like always, if you enjoy this our news article briefing, please share it with your family and friends so that they can become more monetarily aware. And as well, if you're new to Rethinking a Dollar, click the subscribe button below for more RTD News updates as well as RTD interviews. Let's dive into it. Here we have the first article, Russian-Iranian bank may ditch the US dollar. Next article, former Treasury Secretary says bank may be riskier than 2008 crisis. Word out of whack, talking about Aussie's bank, Australia. We have Uzbekistan, I don't know if I'm pronouncing that correctly, but has world's craziest currency regime. 4 reasons why your nation will kill cash for a digital currency. And the last one, U.S. public pensions turn to currency as a returns sour. And also, before we get started, I wanted to mention to you the RTD Cash the Society t-shirt giveaway. I'll include this link below for more details. Having the first drawing next Friday. Looking to give away some free t-shirts to help people become more monetarily aware, as well as get the message out there of the importance of taking interest in these matters. So let's dive into the first article. First article: Russian-Iranian bank may ditch the U.S. dollar. So it's a relatively short article, but it has to do with the idea of Moscow and Tehran beginning to do more bilateral deals in the near future. And it gives a little hint as to why. Basically, if they're going to use and be doing more business amongst themselves, they rather use their own currencies as opposed to using the dollar and the euro as it is now. So just to give you a little insight, it says Moscow and Tehran are actively working on opening a joint bank which plans to carry out operations in national currencies, according to the former president of the Russian-Iran Friendship Society. The decision of setting up the bank was agreed last year, but Western sanctions against Tehran have been the main obstacle. It says at the moment, all banking operations between Russia and Iran are carried out in dollars and euro. It's very inconvenient because all these operations are controlled either by the EU or US central banks. He added that the Russian ruble could also benefit from the bank's entry into the Iranian market, which would enable Iranian companies to buy Russian goods and in rubles. And so just basically last year, the countries agreed on developing economic ties, with Moscow promising to provide a $5 billion state loan to Tehran to promote industrial cooperation. The loan is expected to boost trade between the two countries to reach 10 billion from the current 1.6 billion. So basically, the goal is to eventually, get away from using the Federal Reserve note as its primary medium of exchange and basically just begin opening things up, which is not a good sign for the dollar because those two countries there, if they're doing, expecting to do 10 billion dollars in the next couple years, imagine just removing that dollar sign from that and using approximately 10 billion in their own currency. That's 10 billion, yes, less US dollars and Federal Reserve notes being used, which means they'll probably come back home here and drive up prices here. So interesting story if you guys are interested in checking it out. Here's a story here from the Sovereign Man, written by Simon Black, and its former Treasury Secretary says banks may be riskier now than in 2008 crisis. So he basically just starts off talking about how his recent trip, through Miami back to wherever he's at, was involved with some TSA agents on having a bottle of water he forgot about in his bag, and just how the TSA agents just jumped all on him and actually just, kind of made him feel uncomfortable in the fact that they are harassing him over a bottle of water when the airport itself, Miami, is no safer than any other country. And even in Turkey, he mentions how there's an attack a couple months back that killed 41 people, and that's one of the most safest security airports in the world, being that they have metal detectors when you walk in and yada yada yada. So he goes on to talk about the whole financial crisis in 2008 and how the public are led to believe that the banking sector is safe. Like even leading up into 2008, how all the policies and regulations that were in place saying that your money's secure here and there and your investments are safe, which turned out not to be the case because a lot of people lost a lot. And those involved with Bear Stearns, Lehman Brothers, Merrill Lynch, Washington Mutual, Wachovia, some of the most established banks in the U.S. collapsed. And so he goes on to say how since then they've implemented new regulations and laws such as Dodd-Frank Wall Street Reform, Consumer Protection Act, signed law in 2010, and those are all designed to give the illusion that the banks are even safer now than they were back then. But he goes on to say that it's not really all that safe when you have a U.S. Treasury Secretary, former Larry Summers, coming out saying that, to our surprise, we find that the financial market information provides little support for the view that major institutions are significantly safer than they were before the crisis, and some support for the notion that risk have actually increased. So basically, just saying that, when you have a person that's inside coming outside to tell the world that, there's really not much difference, nothing really has changed, it's probably a lot worse. He goes to let you know that there are some concerns, especially when an insider begins to tell the truth. So, interesting article if you want to check it out below. Here we have an article from Capitalist Exploits, and it's World Out of Whack Aussie Banks. And so it's a quite lengthy article, but yet it basically paints the dire straits down in Australia of the big four banks there in its relation to the housing bubble that's forming there and the financial markets there that's tied directly to the Chinese markets, and just China being their biggest trading partner. How the economy in China goes will affect how it goes down in Australia. And so a lot of good points are mentioned here, but there's a couple charts here that kind of shows how interconnected their banking system is. And so it just basically shows some recent graphs, which was brought to his attention, the gentleman who wrote this, and then how each one of them shares similar patterns, all tied to the idea of just continuous Australian paper printing, or their central bank, they're printing paper, and just basically the market's over leveraged, as he puts it, when saturated with debt. Then he goes on to the bottom to talk about how this type of debt, only affects those who know very little about it. And he talks about how they haven't had a quote unquote recession in the last 25 years, but yet so people think it's not really likely that there is one to come. And he's saying just wait and see. In regards to the idea that the Australian household debt to GDP is now over 122%, one of the highest on this ball of dirt, or this planet, as he mentions. And so basically those that are involved with those big four banks, savers, depositors, investors, shareholders, those are the one that when the Chinese market or a global market or whenever that hiccup in the road comes, are going to feel the pain. So once again, nothing different than what's going on here in the United States. The banks run the show, and once they go down, everybody goes down with them. So interesting article. If you're interested in taking more and finding out more about it, it'll be below. Here's another interesting article out of the economist21.org, and it has to do with Uzbekistan's recent departure or passing away of their president there, and just how some of the currency turmoil is starting to hit the fan. And it's similar to most of the countries in that region there, right off of the outskirts of Russia, where the currency, it's pegged by the government at one price, but then on the streets or the black market, it's something else. And so their currency there is the Uzbek, if I'm pronouncing that correctly, Som, and he mentions two exchange rates, and currently it's 3,000 Som to the dollar, and then on the street, where on the black market rather, it's 6,000. So he talks about how just that disparity right there creates a problem and just overall price inflation, because as of 2015, it was 8.7%, which is, he's saying, is actually low compared to the usual double figures that it usually is. And so he's saying even those numbers are faulty. Then he goes on to talk about just some small examples of how inflation, because of these two different valuations of the currency, is actually a lot higher, and it's causing problems there for the people. And just, it's an interesting phenomenon that's occurring, but yet it's just more of a hands-on display and visualization of what central bank there, and just faulty numbers and continuous lying by the politicians there, saying that everything is okay when people can actually feel on the streets that it's not okay because inflation is going rampant. So one example of many of just a manipulation happening with currency. So interesting article. If you're interested in checking it out, find it below. Another great article: 4 reasons why your nation will kill cash for a digital currency. And so briefly, good article. Just as reasons are quite obvious. The best way to control a nation is to control its money supply. Second one is take advantage of Bitcoin's technology before it goes viral. Basically saying that most of the people as far as the tech heads and the younger generation are aware of Bitcoin, but the older generation are not. So before it becomes even more mainstream, the idea of them getting involved and getting a digital currency to be kind of the introductory to the older generation is what the banking system is trying to do, or would like to do rather. Number three, more practical reasons, such as if you're in a major Western nation with a huge GDP like the United States, well over 95% of your money is already digital. People have become very well conditioned and trained like dogs to spend their money digitally, not in cash. Most major national economic powers have 80% plus of their people using plastic or computers to spend their cash. Famously, countries like Sweden are pretty much moving cash from their systems outright this year. A nice beta test has been scaled up in larger nations in the years to come. Governments won't have to spend billions of dollars, pounds a year on to protect large sums of paper assets, and banks print paper currency and redesign it to prevent counterfeiting every way a year. So it makes it more convenient, the fact that they get to save some money by not having to print and run the printing press, and as well as secure all the paper and counterfeiting departments, and just makes it a lot cheaper to just have a digital system that everyone is forced to use. And other than that, just the economic model has failed. Basically, the fact that everybody knows, or everybody will begin to know, that we're currently into or in a global recession where there's no real growth, and so there's a contraction in all fronts because credit, no one is borrowing like they used to, no one is producing because who's buying. So just the whole interconnected of our system is basically just imploding. Government is even getting crazier with all these CSI, TTP, TTR, all these acronyms for crazy trade deals and stuff that no one really knows nothing about. So basically, he's saying we're coming to the end where the traditional model of lending and the idea of central banks controlling everything, they're going to lose control, or if they have not already, and people will begin to really notice. So that plays into why the whole idea of central banks beginning to look into digital currencies is becoming very popular. So article below if you're interested. Here's the last article here from Reuters, and it's U.S. public pensions turn to currency as returns sour. So basically, in a nutshell, a lot of public pension funds are underfunded, and so they're trying to chase yield to basically live up to their promises of being able to return to investors their promised returns of 7 to 8%, give or take, whatever the promise is for whatever they're invested in. But yet he's basically just going here to create an author here saying, just giving a lot of dollar figures and kind of saying that equities and bonds aren't really returning much these days. So a lot of hedge funds, for the sake of kind of trying to diversify to what traditionally has been good returns on their investment, are not returning anything. So they're not getting in the currency. So they have, as they mentioned here, I think Illinois, they're hiring outside firms to come in and actually specializes in currency trading and things like that, trying to chase that target levels of averaging 7 to 8%. And then what's alarming is, as you scroll down, it actually mentions what actually has been returned. And so 7 or 8 is promised, but yet, let me see here, mentioned, I think it was 3, let me see, the following returns, oh yeah, here we go here. Returns for currency funds are steady so far this year. The Barclay Hedge Currency Index with 66 FX programs was up to 1.4% for the first 8 months of 2016. That followed returns of 4.7 last year and 3.4% 2 years ago. So basically 4.7 and 3.4 is nowhere near the 7 or 8 that's promised. So there's going to be a shortage somewhere down the line. So once again, even though they're doing their best to live up to the promise of being able to pay out one day, they're still going to be majorly underfunded because they can't really return much to the investor, not being able to live up to their expectations of 7 to 8%. So more details here, more numbers, more all that stuff right there if you're interested. But basically, hedge funds, investors, portfolio, pension fund managers are all out there chasing yield, which they may not find because of the monetary policy that is against the public. So anyway, if you enjoy these articles, feel free to share, subscribe to RTD. Looking forward to bringing more news updates. Enjoy your weekend. Thanks.